Where to put a stop is one of the common question which I get, and this is a issue which beginner traders have a lot of trouble with because they're not very clear whether to put stop, or they have these presumptions that the market maker is after their stop, or they don't know where exactly to put a stop. So in this video, I'm going to look at various ways in which you can look at stop strategy. One of the things, if you want to determine your stop, what kind of a stop you're going to use, is first to decide what kind of a setup you're going to be trading. Now, if I'm trading a setup which is 3 to 5 days of move, which is inherently the way the market operates in the short term, then if I put in a stop of 10-day moving average or 10 20-day moving average on that kind of a trade, it is of no use. What then I have to look at is a stop which will be in line with the kind of setup which I am trading. Now, as against that, if I am trading a long term trend following kind of a methodology where you are saying that I'm going to buy this stock when it goes above 40-day moving average or 50-day moving average in, and then going to hold it for a longer period of time. Whenever you want to hold something for a longer period of time, then a trend following kind of a stop, which can be a 10-day moving average or a 20-day moving average, makes sense because you're trying to catch a big trend. So whenever you're trying to catch a big trend, you have to give it some room to run. Now, if you are trading a setup which is based on support and resistance, now the very fact that your setup is based on support and resistance is going to tell you where to put your stop, because you will, if you are going to be buying at a support, right, or you're going to be shorting at a resistance, then what you are going to do is you're going to put your stop where the support will be violated, which will negate the trade. So if you look at, say, an example of that kind of a thing. So let's say if you're doing support and resistance, and on this particular day, you see the stock making a move. You want to get into it because it's near support. Now, obviously, because it has a support here, you can put a stop here, and if it doesn't get violated, then the trade works and the trade goes in your favor. Now, if you are trading this setup as a resistance, you will probably move your stop once it crosses resistance, and you might make your stop here. Now, if you're going to be holding this trade for a longer period of time, you might use the moving average as a stop. If you're trading this thing as a short term 3 to 5 days short, then you short it here. You cannot have a 10 days moving stop. You have to exit your stop, or your exit will be a function of your holding period, and which is 3 to 5 days. So, whenever you're doing these momentum burst kind of trading, the stops are very close. So if I'm going to be shorting a stock like this, I'll put my stop at half of this day's range. So in case it gets violated, that tells me that it is not going to work. And then my holding period is only 3 to 5 days. So accordingly, I move my stop to lock in profit. Now that's the fundamental difference between, like, and if you're trading short term, then you need to have your stops which are short term. If you're trading long term, you need to then give it a room to run. But that's not the only way in which you can put stops. The other ways in which you can use stops is when you are holding position for long term. Then you can use the position size as a stop. So what is the position size as a stop? Let's say that, let's assume, let's go back to the same example, and I research this stock and say this stock is at a turnaround. This is a stock, let's say, like, which had some issues. It's a company which has been around for many years, and it has a history of continuously going up. So I think that this stock is likely has put in a bottom, and I want to hold it for year or two till it recovers or makes a new high. So in that case, I can, like, decide that I'm going to manage this position by position sizing. So I might decide that, I'm going to put 2% of my capital in this position. So when you put 2%, you're risking 2%, but in reality you're not going to be risking 2% because you might have, like, say, if it goes down 50%, you might decide to get rid of the position. In that case, your stop is just 1%. But position size based stop, where you decide that you're going to be buying the stock for a long term, and in that case, you're going to have 30 positions, 40 positions, 50 positions. So if you're going to be having 50 long-term positions, each positions is 2% of your portfolio. And then you don't have to worry about it, because in case the worst case scenario it goes to zero, the worst case scenario is you're going to get a 2% loss. So this is the way many types of long-term methods are traded, where you have a total position sizing as a stop. Or there is a hybrid approach where you have a position size as an absolute stop, saying that I'm not going to be holding any position which is more than 5%, but like then in addition to that, you have another stop which might be 10% below your entry. And that's the other way in which you can manage the stop. Now, that's by managing the position size, absolute size of the position becomes a stop. This is the kind of a method which is also used in a lot of quantitative trading, or when people are doing automated trading, and especially when they don't want to risk too much on a position, then they limit the size of the position itself, so that your stop is not going to hurt you, especially in mean reversion kind of strategies, where there is no stop which is used, because the more the position goes against the prevalent trend, the more likely it is going to bounce back. So in those kind of a thing, the traders control their risk by position sizing. So they will put a position size 2% of account or 1% of account, so that worst case scenario it's not going to affect them. The other kind of a stop which was popularized by Nicholas Darvas was what is called as a structural stop, or a stop where once a stock breaks out, he put the stop below the consolidation low. So let's say like find an example of something like that in recent time. So let's say past is an example of our stock which had a recent breakout from a long-term consolidation. Now, in this particular case, if you are entering on this day, then the Darvas kind of a stop will go below this consolidation, or the box low is where he was putting the stop. So that way, when the box low is violated, is when the stop position gets taken out. Now, this position, let's say, goes in your favor and it goes 10-20%, and then it forms another consolidation like this, and then it breaks out. Then he would move the stop again below the consolidation, and that is how he was able to hold the position for longer term. So, if this is the consolidation, there's a consolidation breakout, he put a stop here, then he kept on holding it. It formed a new consolidation, and then once this consolidation had a breakout, then you put it here. So, at some stage, one of the consolidation is going to break down, and when it breaks down, he will get stopped out. And his methodology was designed for holding positions for longer term. And the reason why it worked for him and it may not work for you is because he was not buying random stocks. He had a set of criteria the stock had to meet, 8 or 9 criteria he had before he bought Darva's box on it. So those stocks had the characteristics of growth stocks. Those stocks had the characteristics of stocks which are likely to make 100, 200, 300% move. And that is why his particular stop strategy worked. Now, whenever you're looking at putting stops, you also need to understand the volatility of the stock itself, because some stocks are highly volatile and some stocks have low volatility. When you are looking at a stock which are low price stocks, supposing you are trading stocks which are priced at $3, $4, $5, what happens in that case is those stocks have very high volatility, and because they have high volatility, what you need to do is you have to compensate for that volatility by putting in stops which are wider. Because if you're looking at stocks, like say if you're trading stocks and the price is very low, so in that case what happens is those stocks tend to have much more wider moves intraday, and as a result, if you put a close stop, you're going to likely to get shaken out of positions like these. So in order to trade lower price stocks, you need wider stops. And as against that, whenever you're trading high price stocks are a different animal. They don't have that much amount of so this is a breakout on this particular stock, and as you can see on this particular breakout, the stock was up only 2%. So you can put very close stops on high price stocks. High price stocks typically do not require wider stop, because high price stocks are not typically traded by retail traders. High price stocks have more institutional kind of trading, so their moves are more linear, and their moves are more predictable, and as a result, you can put closer stops on high price stocks. So that's another thing. A lot of traders are trading low price stocks, and then they're putting very tight stops. That doesn't work because the inherently the volatility of that particular stock is higher, and as a result of that, you will get stopped out. The other way of putting stops, which a lot of traders do, and then they get frustrated, is like they're trading a swing trade of 3 to 5 days, or they're trading position size like in a longer term kind of a trend, and they go and then put a stop using a lower time frame like 5 minute chart or a 10 minutes or 15 minute chart, and then they get shaken out, and then the stock goes. Because if you are going to be trading swing based on a daily kind of a time frame, then you need to give that stock move to run, because what is going to happen is that stock intraday might go down, but it might recover by the end of the day. And if you use intraday strategies, then you're going to be getting stopped out. If you want to use intraday stops, then your setup has to be intraday. So that's another reason why you see a lot of frustration in stop. Now, generally, I get a lot of questions about stops, and when I dig deeper, the reason why a lot of these new traders have problem with stops is because they're not very clear about their setup. So once you decide your setup, a stop is a specific to that setup. What works as a stop for me for a high price stock is not going to work for you if you're going to be trading low price stock. What works for me for EP is not going to work for you if you are holding EPs for a longer period of time, or you're holding EPs with a different kind of a mindset. So, or you're looking at like getting a very precise entry in EP, then the kind of stop strategies which you'll need will be different. So these are all the complexities of stops, which is why beginner traders have a lot of trouble with stops. But as you trade more and as you become more clear about setups, you will see that stops become easier to manage, and you also realize that the positions which work really work from the word go. If I get stopped out, I don't feel bad because I know that position is not likely to work. What works, you don't stops never come into play. If the position is not going to work, then the stop is going to come into play. So that's one of the ways to look at stops. And if you are struggling with stops, I would suggest the first thing is look at your setup, because if your setup is clear, your stop will be clear. If your setup is not clear, your stops will be all over the place.